Well, we are going to be talking more about this with our analyst, Jeff Lindsay. He's senior analyst covering the internet at Sanford C. Bernstein. And Jeff, you know, hearing the report from Bureau and, of course, following this very closely, what is the suspension of Google in China really all about?
Well, really, it's a very politically sensitive time in China right now. And, you know, in a way, this has been coming for some time. There have been crackdowns on all of the search engines in China and a lot of the internet players, but especially Google. And I think, you know, it's not unexpected, but it's now finally happened, and so Google has to deal with it.
Right, and you've mentioned before, I mean, it's still a very small part of their revenue, China is, so it's not an impact on their bottom line. But this, with China or any other country, it's never really about the revenue in many ways. It's about something bigger than that. I mean, what's the risk for investors to think about this?
Well, it's several things. Really, does it threaten Google's position in China? Because China is the largest internet consumer market now, and it has massive growth going forward. And so it's not so much about this year's revenues or next year's even, it's about the next 5 years. And how well is Google positioned to really take advantage of the massive growth in the internet in China?
Now, it seems as if Google right now, because it's so big, is being targeted by everybody. And we're hearing a lot about the Bing-Yahoo partnership going forward. How much does Google have to worry about this?
Well, I think it has to take it seriously. Microsoft has come back with a much better challenge this time than previously. It had Windows Live with cashback. None of those really went anywhere. But with Bing, they're appealing directly to the consumer. Rather than challenging Google where it's strong in search effectiveness, it's changed the interface and it's appealing directly to the end user. And that way, Microsoft, for the first time, is actually building some share. It's gained about...
Right, and it seemed to have caught the those at Google by surprise.
Well, here's the irony. Google has many of the same features. It just doesn't publicize them. And really, that's how Bing has caught them. Microsoft has caught them completely unawares. I think it's not very difficult for Google to catch up and to basically start doing very similar things and to publicize them just as well. But it was a little bit of a wake-up call.
Yeah, and you just heard from Bureau talk about the fact that maybe the bigger risk for Google is the fact that they're being attacked on all fronts, which means that they have to spend more money in order to catch up to other players. And in that sense, they've got to spend more money at a time when we clearly see spending is down among consumers and consumption is.
Well, we've looked at that, and also Google have to increase expenditure on very basic infrastructure like server farms. And we recently published a note on that. It doesn't really add up to that much. Google's cash flow is enormous. Its free cash flow is about $8 billion. Its operating cash flow is about $10 billion. So it's got plenty of money to spend. But however, it really must take some of these threats quite seriously. It has to react to them, otherwise it faces losing share. And of course, that will undermine investor confidence in the stock.
Okay. Jeff, great to talk with you as always. Thanks so much. On Google, Jeff Lindsay, senior analyst at Sanford C. Bernstein.